Can a life insurance policy owner also be the beneficiary? Imagine planning your future and wondering who will benefit from your life insurance. It's a question that can shape your family's financial security for generations. Let's break down how life insurance works. There are three main roles: the person whose life is insured, the owner of the policy, and the person who gets the money, called the beneficiary. The insured is the person whose life is covered. The owner controls the policy, pays premiums, and makes decisions. The beneficiary is the one who receives the payout after the insured passes away. Most times, the owner and the insured are the same person. That means you buy the policy on your own life. Usually, you name someone else as the beneficiary, like your spouse or children, to receive the money. This setup helps build wealth for your family and make sure the money goes directly to them, avoiding delays in probate. Now to the main question: can the owner also be the beneficiary? The simple answer is no, not in the usual way. The reason is that the purpose of life insurance is to support others after the insured's death. If the owner and the insured are the same person, and that person dies, they cannot receive the benefit because they are no longer alive. The money then goes to the person or people you named as beneficiaries. However, there are some situations where the roles might seem to overlap but don't actually mean the owner is the beneficiary. For example, if a family sets up a trust to own the policy, the trust is the owner. The trust then distributes the money according to its rules. The trust itself isn't the beneficiary. It just manages the payout for the benefit of others, like minor children or family members with special needs. Another example involves a business owning a policy on a key employee. The business is the owner and the beneficiary, but the insured is the employee. This setup is different from an individual owning a policy on their own life and naming themselves as the beneficiary. For Black families and communities, understanding these roles helps make sure life insurance does what it's meant to do: protect your loved ones and pass down wealth. Naming the right beneficiaries and keeping those choices current is key. It ensures the money goes to the right people, whether that's children, grandchildren, or a trust set up for their future. Some practical tips include always naming specific beneficiaries instead of just "my estate" to avoid delays. Consider naming backup beneficiaries in case your first choice isn't available. If you have minor children, think about setting up a trust so the money is managed until they're old enough. Review your beneficiary designations regularly, especially after big life changes like marriage, divorce, or the birth of a child. In summary, the owner of a life insurance policy generally cannot be the beneficiary in the traditional sense if they are the insured person. But understanding how ownership and beneficiary choices work helps families use life insurance effectively as a tool for building and passing on wealth. Making smart decisions about who owns the policy and who benefits from it is a simple step toward securing your family's financial future.